Okay, and I'm just going to get right into it. So I'm going to share my screen, and here's a presentation. Everyone sees it. I'm going to talk about the Great Rotation, and I'm going to talk about gold as an emerging strategy. I think that gold really makes a lot of sense. I gave a presentation. I actually had two institutions contact me. They like my idea so much. One wants to potentially hire me as an emerging manager. So I'm putting a little more emphasis than I normally do. But I think that the thinking is credible, but it also should be seen in the great rotation context. So I think that we've entered what is an inflationary commodity cycle. And I think that what this is it's the back end of 4 decades of declining interest rates, and basically bubbles in stocks, bonds, and real estate have all had 3 standard deviation moves above trend. And now with rising interest rates, or higher interest rates, their overvaluations are unwinding. And I think that this process is going to be protracted. And during that period, gold, precious metals, and commodities will outperform. One of the reasons I feel strongly about this is Jeff Gundlach's a very talented uh, strategist, and he had pointed to this chart, and I've used it, and I come up with my own variations. But taking a look at the CRB, Chicago Research and Trading Index, uh, excuse me, Chicago Research Bureau index relative to the S&P, you get some very defined moves. And what Gundlach pointed out about 5 years ago is when it happens, you get outperformance on the order of 700 to 900%. And that's quite considerable. And if you're managing money like many of us do, you want to catch some of that action. So I've been following it. And what we have, most people don't remember, but from 1999 to 2008, oil went from 20 to about 170, and then it reverted. And that I call the deflationary cycle. But during that inflationary cycle, you saw stocks not perform, commodities and oil did really well. And then during the subsequent 10 years, the 09 to 20 period, stocks did great, bonds did great, growth stocks, tech in particular. And that all changed in 2020. I think you got a bottom there in oil when it got down to $12 negative in the future markets. And now it's reversed, and I think we've had a nice move in commodities. They've pulled back in the past year, but I think that this cycle will continue. Another factor in the way I see what's going on is that inflation is an important factor in these cycles. And I'd found this particular chart of great interest. And where you take a look at the S&P 500 and divide it by the PPI, and you get these clearly delineated deflation and inflationary periods. And so we all remember the 70s, where oil did great and gold did great or silver did great, but the stock market was terrible. Bonds were terrible. And similarly, you had that in the 2000 to 2010 period. And I think we've entered into that period again. And it's also interesting that this also happens after stock market collapses, which we had in, or peaks in 07, 1929, 71, 2000, 2022. And one of my arguments for gold is that a lot of money is managed quantitatively. And what people do when they build these things, or at least the ones that I have, is they try to look at an expected return and they look at the correlations. And one of the things about gold is it's non-correlated largely to stocks. It's gaining momentum, and it's a historic inflation hedge. And I think that right now you're going to start to see gold outperform, and more money is going to go into it because it's performing. But there are other fundamental reasons. One is central banks are buying gold, and they're buying it because they prefer that to other currencies. And also the sector itself looks like kind of a classic bottom in terms of the amount of productive resource available has really declined and reserves are very low. So it's a typical cyclical bottom. I'm going to just check here, see whether I got some other people I need to add. And forgive me for a second. Oh, people are adding themselves, so that's good. Hello, Chris, Scott. All right. But moving right along. Sorry. Crescat Capital does very good fundamental work on gold stocks. And what they pointed out in their year-end letter is that gold companies are generating near historic cash flows. They're buying back stock. Their dividend yields are near historic highs. Their cash levels are high. They're at the lowest PEs. You know, mining as a percentage of the S&P 500 is near all-time lows. Central banks are buying it. And, you know, that to me is just, that's a classic bottom in a sector that you want to own. Sorry. This was a great chart. This is of gold producing countries' central banks. The central banks of countries that produce gold are actually buying gold, and the purchases are going up. So if you combine that with the fact that the production has shrunk, and interesting, one of the reasons that gold production has shrunk is that people are mining for these green metals. So the amount of supply available or productive capacity is shrinking at the same time. Suddenly you're getting what appears to be a very meaningful increase in central banks buying gold. And that could be because they like to hold the dollar as part of their reserves, and the dollar is starting to lose momentum. But it could be that other currencies also, I think, act poorly. And if you ask me, they're all fiat currencies, and a lot of countries are in their central banks have really been reckless and not conservative. So that makes sense to me going forward. And it's worth looking at the historic performance of gold. And, you know, not everybody is old enough to remember this, and I certainly haven't been a gold bug most of my life. But, you know, in the 1970s, gold was still waiting to be let in. All right, I got an email here from a client who's saying, I want to get let in, so forgive me for a second. You know what they say about technology. Okay, some people are in the waiting room, and I've just added them. Thank you, Mr. DeBugash, for letting me know some people were waiting. Let me go back to where we were on the screen share. But the point is, when gold moves, it often has very significant moves. And the move actually in the 1970s from 35 was up to almost 700, 677. That was a move of 18x. Now that came from a mandated or regulated $35. So it wasn't really a free market move all the way. But you had a very significant move in the 2000 to 2010 period. And that was 6x. So catching a move, and if I'm correct, I think that that's the potential you have here. It's very significant and can add meaningfully to somebody's returns. Now, I was talking about the great rotation. So another chart that I find very interesting is that you actually have similar cadence to a ratio of gold versus real estate, where gold really outperformed in the 1970s. Real estate did great from the 80s to 2000 when stocks were doing well. But then gold did well from 2000 to 2011. Real estate did well up until recently. And now I think that ratio is pointing downward and suggesting you want to be long gold. We also know there is a correlation between gold and the dollar, and the dollar is now turning down, and that suggests that gold should do well. Hello, Alan. Did you get in? I'm sorry, hold on a second. All right, I need to do a little bit more work here on adding some people. Admit. Screen share, stop share. Okay, all right. Now it looks like, sorry everyone, technical difficulties. Going back to my screen share. And as I was saying, I really think that commodities, in particular gold, should do well. And this is part and parcel with these cycle shifts. And interestingly, we're now seeing the emerging markets start doing well relative to the broader global markets, or they should do well during this cycle. And I think that relates to commodities. I think there's another factor that's happening, that growth is outperformed and it is no longer outperforming. And I like to look at it in the 2000 bubble. You got a huge move in growth stocks. And it took about 8 years for that growth stock premium to really fully collapse. And I would say we're now 1 to 2 years into that. And I expect we'll see further declines in growth stocks. Value will do well, emerging markets will do well, commodities will do well, gold, precious metals. And again, I think that the argument to be long equities is not compelling. The risk premium is at 2.1%. And that's okay. It's not bad. It's not a sell signal. But I think you also have to think about, well, what are we thinking about earnings? We don't know where earnings are. Right now, people are very concerned. We're getting some mixed signals. We're seeing, slowing retail sales. But on the other hand, we're hearing that, China should be opening up. And we also don't know where bonds are. So again, I think that money will be flowing to those areas that have that aren't stocks, bonds, and real estate as much, and gold will do well. I noticed that last week the S&P earnings for this year actually ticked up just a little bit. I doubt that's going to continue, but we definitely need to be watching earnings. And I think that's really what professionals are going to be looking at over the next few weeks as earnings get reported. That's a little about me. The next speaker is Rich Gula, and Rich has spoken previously on our calls. And just about him, he worked at Putnam Funds and Bay Banks, and he ran several $1 billion. He worked for Dean LeBaron, a famous quant, and also under Ned Johnson over at Fidelity, set up the modern chart room, and really knows all the big names in money management. His technical, quantitative, and market experience are really excellent. So with no more ado, I'm going to have Rich start speaking, and I'm going to stop sharing this. No, I'm going to continue to share. So everyone sees Futu Holdings. Go ahead, Rich. Can you hear me? Rich Gula? You might be on. Rich, are you there? Not sure what's going on here. Forgive me, folks. I don't know why, but All right. Rich Gula, you were on before. Sorry, folks.
He's muted.
Muted. Here I am.
All right, Rich Gula.
Sorry about that.
All right. What is
Listen,
Q2 Holdings, and tell us what your take is on the market for all these stocks.
First, talking about gold, two thoughts came. One was there were two sisters from Louisiana that were always hawking gold, and they were very good, but they don't show up in any search on Google. However, under gold bugs, it does mention the company you keep includes Ron Paul and Alan Greenspan and Judy Shelton, who would have completely upset the Fed if she had ever gotten onto it. So there's always hope. There's always hope that she'll be put on by the next regime, so to speak. Anyway, a couple of thoughts about the market. First, that 5% intraday moves in stocks is now typical, but it is not normal in any way. There's a lot of algo activity that is present usually Tuesday through Friday.
Excuse me, Rich, I have Ellen, the nurse from Dr. Healy's. I have two questions. Do you have a sore throat?
No.
Are you bringing up anything with your cough?
No. Anyway, I was
He's in the hospital with COVID, but he's calling because this is such a important call.
Don't get me going on COVID and what it really is. But anyway, today, because what flashed on CNBC was that Schwab, Allstate, and Northern Trust were all off more than 5% today, intraday. And you wouldn't consider any of those speculative stocks. It's not Shopify or any of the iffy, as I call them, stocks. So there's a great deal of that kind of pricing going on. And Tyson and I have talked about this ad nauseum. It has to be due to the way ETFs decide to rebalance or put cash to work or take money out. But that is now going to be a constant influence as we, move our way through this cycle. The other thought is that, and I didn't include the chart this time, but the 10-year future at 339 is got to be a head scratcher for the Fed. It just doesn't ring consistent with their hawkish discussions and proclamations and speeches and so on. But given that backdrop, the one thought I have about how the 10-year future trades is that if you were really, really bearish and you had a bond portfolio positioned that way, you might use the 10-year future to hedge that position for periods of time. But 100 basis point moves in the 10-year future, that's an awfully big move historically. I talked to two bond guys who just say it. They say nothing is impossible or atypical anymore, but it's a real head scratcher. Anyway, all right, on to charts. First, if China reopens, a variety of interesting possibilities occur in terms of impact on earnings in U.S. companies, and I think it feeds into Tyson's gold scenario. If I were going to make a guess, the Chinese central bank would be a pretty significant buyer of gold, and I think it has been for quite a while now. Okay, next slide. Actually, there's a little, these are pairs. So if you can do, that's Blackstone. This is the mortgage-backed security ETF. And the third one is actually a trio. And the Vanguard Total Bond Fund, which is the largest bond fund. Blackstone isn't quite recovering yet. Somebody has been in the process of saving those bond funds, in my opinion. That it was very strange. They all turned on October the 12th. Nothing is coincidental. Big spike in volume there, and also in BND in the next slide, Tyson. Although they are, but that's actually quite interesting. In other words, for every seller, there's been a buyer in the bond fund, in that large bond fund at Vanguard. It could be their asset allocation strategy for their clients, but there's no dip there that suggests the bear market. It says that money has flowed in continually. And that, I would think, it also a bit of a head scratcher for the Fed folks. Okay, next 2 slides. BlackRock and ICE, 2 companies that are kind of tertiary financials, as I think of them. Primary is JP Morgan, Bank of America, the usual suspects. Secondary would be Schwab and Ben Franklin and those sort of intermediaries. And third are the folks that do stock market stuff as a business. And so BlackRock certainly qualifies. ICE does. State Street would be in that same category. What's interesting here is these charts, if they break that sort of resistance level that catches your eye, it's up against the upper part of the channel. Those are hopeful bullish charts that could also fail right here and take you down very hard. I had a number of emails this week from folks that said it was what was occurring over the weekend was the moat. It was the mother of all trend lines that had been drawn, and that was that trend line was so significant that if it was broken, you would have to become wildly bullish. None of the people that sent it to me were bullish. They were all saying, this is not good. And I concur, it's not good. It's a very tricky time at this point.
That was a downslope line on the S&P, is that correct?
Yeah, but it was on virtually every average except the NASDAQ, which of course has been destroyed as a chart. That'll take a long time. But and I think it was pretty close on the Russell as well in the mid cap. But you know what you usually do? You do the 500 and the 100 to see if they're parallel or not, and they were very close. The next 2 charts, however, in the rest of the world, it's hard to believe that somebody would be buying European stocks. But first, it's the first chart is the MSCI Core Europe ETF. So that's just going to be a market cap weighted instrument. And then the next one is the Stocks 50, which is obviously very passive, but that's a subset of the MSCI, which would have many smaller cap stocks involved in it. It's very curious here that those charts are way out ahead of the U.S. And you talk about opportunity loss. If someone who bought the trough as an international manager in October, not only got a substantial move in the euro, but got a substantial move in the stocks because this is in dollars. So I have to assume that this is muted over what it would look like in a euro based chart. And so why, who, what, why, when, what's going on here? Next 2 charts, we have gold and we have Upstart. And I put Y by both only because I knew that Tyson would give a pretty good case for gold on the upside, but I haven't seen anybody write a good white paper as to why you absolutely destroyed all of Cathie Wood stocks. I suppose that some of them were just overvalued on the basis of the dot-coms that we remember fondly from 2000, 2002. But the gold chart is very fascinating because this one goes back, you're talking a level here, about 190, 19, this is GLD, this is the trust. You're talking about a break above 2000 in gold that has a huge base now. And that's going to catch the attention of a lot of people that don't like gold. Anyway, it's pretty positive. Next chart is, I would advise anybody to buy 10 shares of OUSA. So you get all the stuff from that outfit. That's Kevin O'Leary's investment management firm in Toronto that runs this. And that's got a much better configuration than almost any US ETF. And it basically is buying dividend paying high quality stocks. Next chart. Dick's, somehow no one found out at Dick's that there was a recession. This doesn't make any sense, but especially when you contrast it to Nike, Under Armour, Adidas, and then Kohl's and Target, which are different. But Dick somehow has a mixture of products and clients that has kept that stock going up. And that's not far away from breaking out on the upside. So you see the 10-year future moving in one direction, and you see this moving in another direction. And I think that it's just the usual confusion that comes late in the cycle. Okay, next chart.
Virtual visit or phone call today? Virtual visit or phone call?
IWM, the Russell usually leads off of a bear market bottom. It's I wouldn't be putting the Aunt Tilly's fortune into this at this point, but I'd be keeping a pretty good eye on it. And it's not quite a bear market chart either, though. Realize the Russell should have been down that low in September, should have broken and gone to a much lower level. So somebody's been stepping into small caps. My experience of working with small cap managers, they almost always know their companies better than the large cap managers do, because there's nothing more embarrassing than to have a 40 stock small cap portfolio and have a stock down 20% and have a client call up and say, what happened? Last two charts. This is the long-term view of the S&P 100 and the mid cap. What's curious about this is that your eye will kind of go, I realize the resolution is not great because I didn't blow it up enough, but there was a 4-year low in 2020 that would argue for the next 4-year low in 2024. So either we have a dramatic bear market that is going to last straight into that, or maybe there's a run here on the upside, which I think is going to be very tricky if it occurs, because it's going to be basically I have to put money somewhere, and it might as well be here. And then last chart. This is the IBES earnings a year forward, and why that's tricky is that I see forecast all the time of 200 for the S&P earnings, and this is staying up around 230. So 19 times 230 is 4370, and 20 times 230 is 4600. So the first is up 12% and the other is up 18%. If you ask me whether I believe those numbers, no, I think there's a better chance that the Patriots will win the Super Bowl again this year, given that anyway, thank you very much, Tyson, and away we go.
So Jennifer Warren has spoken here before. She's an expert in terms of researching on energy and the energy transition. And I've asked her to speak for 5 minutes. Jennifer, tell us what's happening. And I guess I want to just mention, I think that it's interesting that mining, broadly speaking, is seeing a lot of demand for these green metals. And what I have read suggests that the energy transition is a multi-trillion-dollar event, and we need a lot of these green metals. And anyway, but go ahead, tell us about energy. Tell us about the energy transition.
So where am I? I don't know.
Okay. I'm gonna I'm gonna stop having the share go.
Yeah, that's a good idea.
Good thing I did that. Gives me an opportunity to add some other people.
Okay.
Welcome to Jeff Karp. Okay, go ahead, Jennifer.
Okay, so I'm on speaker and everything. Okay, let me just make sure my volume's
See you in your lovely living room.
Okay, so
in Dallas, Texas.
That's right, where all the energy stuff is happening. So there's a couple of things. I talked about this on a video interview that I did on YouTube last week, and I'll kind of do the Cliff Notes version. Basically, I'm starting to straddle the oil and gas and, renewables, energy transition, and increasingly they're converging in some respects. One thing that's primary is always oil price. Where's it going? What are the fundamentals? And I was sort of parsing a presentation that Scott Sheffield gave, the CEO of Pioneer, because Pioneer is basically a bellwether of the Permian. And, he's somebody that I've followed for a very long time just because of my chronicling the shale booms. But he was talking about that the futures curve is a poor predictor of oil price. And he showed a chart that, very much spoke to that. And also what was really interesting was some of the, where you have these big price spikes, like in, I think, 2008, right before, during the financial crisis, you had the run up in price largely because of China. Oil was like 140, then it goes down during the financial crisis to, I don't know, $30 a barrel. And then, the shale boom happens, oil prices get back up to, 100 for a while. Then OPEC decides to take share in 2015, boom, price goes back down. Then it kind of muddles along for a while, and then it goes back up. And then it goes up before the Russian invasion. It goes up also because of the green transition. There were starting to be cracks in the fray of, some countries moving too fast. And then boom, we have the pandemic and oil price drops, it's back up, Russian invasion, we know that story. Just the other thing too is what I was noticing is, LNG, right now, natural gas, prices have been lower and because it's been warmer. And this relates to some of the Europe discussion that Rich was saying. The winter has been warm thus far. And I spoke to somebody who's heavily into natural gas and in Europe, and, winter's coming. And so there's going to be a bit of a dynamic change with that. I noticed that too, Rich, about Europe, and that, the market was starting to look pretty good. And I think some of it's that sentiment that, maybe the recession isn't going to be as bad. Germany seems to be getting their act together with respect to diversifying their energy sources. They're building all these LNG facilities. The IRA legislation that we did, that Europe was all, kind of concerned about, because they were afraid that, because of our IRA legislation, the green legislation, that it was going to deindustrialize, Europe, and that all this business was going to move here. And they're starting to, redress that basically. And we're starting to redress that in our policy as well. But the IRA legislation, what's interesting is I've seen announcements now increasingly by large oil and gas firms who are obviously going to be leveraging, some of the hydrogen tax credits and some of the carbon capture, the CCS tax credits. So I'm watching some of these players, and it's US majors, because a lot of the European majors, they were first movers in deciding how they were going to move in the transition. And now, of course, with Russia, that changes the strategy, changes, the outlook. BP's outlook's a little bit different now, because, they were big green first movers, and now they're kind of going, oh, these resilient oil and gas assets are a pretty good thing, especially in this, increasing oil price environment, which is projected, especially with China coming on board. Goldman Sachs said that, we could see a $15 rise in oil price just because of China. And so with the futures curve not predicting well, and it being a bit on the low side, the view is that, let me get the numbers. There's some of the people I've talked to, there was this $80 to $100 range. Well, now I'm seeing that range go up a little bit, and 90-110 is looking like a possibility. And part of that too is because OPEC is not going to let price drop again, and that's what they were really telegraphing recently when they were like, kind of hem-hawing about demand. Oh, we don't know if China's gonna, tank out, if it's going to be a choppy opening. Maybe there is a recession. They're trying to hold the price, hold the price up. That's one thing. The firms that I noticed were making some announcements. One was CVX, Chevron. They were talking about their RNG business, their renewable natural gas. They already have that business. It's profitable. So the sustainable fuels area is something that I think is quite interesting, and they're a player in that, alongside, being very good at what they do. Exxon was talking about a new hydrogen hub in the Houston area, Houston Gulf Coast area, but they're sort of, watching. So you're starting to see first movers and who is going to try to participate more in, hydrogen and CCS. Pioneer. Hello, something's.
I got it.
Oh,
Looks good.
Pioneer quickly, they were talking about enhanced oil recovery as the Permian plateaus somewhere down the road, which, may be like 2030, but then it just plateaus for like several decades, and enhanced oil recovery is part of that equation. And Occidental Petroleum, Oxy, is a big player in that. I've followed them for a very long time. I've written about their EOR business before all the green talk. And so obviously Oxy's leveraging that, and they have their low carbon business that they're a first mover in, and I sense that that's why Warren Buffett likes them, because they're a really good diversification play as far as leveraging certain technologies and and being globally diversified. Now your minerals, Tyson, funny enough, I was looking at Vail today, and that was interesting. I think there is definitely obviously an interplay with minerals and green minerals and all that, and we've seen prices rising in different areas, and it's a time to be I don't know, I would say use discernment, because there's a lot of hype. So you're getting a lot of momentum in the mineral stocks, and some of it deserved. But, you can see, if in a couple of years, the market decides, oh, you know what? I don't know if there's going to be as many EVs. I don't know if we're going to be able to mine the globe like we think we're going to mine the globe. There are obstacles to the transition that I think we haven't even come across yet. And I think that's why you see like the Exxon saying, we're going to watch this a little bit and see what emerges, because we don't know, is hydrogen is it going to take off? There's a lot of issues with physics with all that. So you just see these differentiating strategies of oil and gas firms playing off their core competencies. Also, the supply chain thesis I talked about before, that's emerging more. And I've got that on a video, and I've talked about it before, but the supply chain issue is, and funny enough, Tim Worth of CVX, of Chevron, talked about this in his third quarter earnings. With this energy transition, it is going to require a lot more collaboration. These oil and gas firms are going to have to partner with firms that, have the hydrogen type competencies and all the supply chains that go with it. You're going to see them buying up over time different players. You're going to see interesting combinations. And so that's something to watch, who's doing what. And pick your poison, so no pun intended there, pick, what it is that you can follow, because it is, the science of everything is tricky, and I do that. I've had to increasingly look at things in a niche way, with the energy transition, and follow the money, but also follow the discerning money as well. So I think oil and gas supply chains, Europe. One other quick thing, LNG. I showed this on a slide, and this was interesting. It was about LNG demand in the future. And we know that LNG demand increases. And we know that there's all these facilities that are going to come on board in the United States because of political risk. In other places that would have otherwise attracted LNG facilities, they're not going to make, like Mozambique. And they're in geopolitically risky areas. And so a lot of these LNG facilities are going to make, those projects are going to make here. So that's, we're a benefactor of that. Now, everybody focuses on China and Europe because, they consume a lot of the LNG, and they're also going to be competing with each other to some respect here in the near future, because Europe's not importing from Russia so much. But the rest of the world, everyone looks at China and Europe, but the rest of the world, the demand of the rest of the world is big, and so that is something to look at. And I have that in a chart in my video that I did. I think it's called something like the fluid energy something. I can't remember. It's my last video I just did. And so, and I'm also watching India. And the other quick thing about oil and gas, so they're about 5% of the S&P, and Sheffield was projecting that, it's going to go to 10 to 15%. Now, oil and gas was 12%, I think around the time of the crisis and during the shale boom. So, the expectation is it's going to, it's going to return to its, natural area. And yes, algorithmic trading is an issue. I can't remember if it's like 60% of the market is algorithmically traded. I think about that, when I'm picking stocks. I'm like, because that's where you get some of that sway, that volatility and that sway, prices getting tossed around differently. So anyway, that's all I have.
Thank you. That's great. I'm going to go to Mitch Belagic, who was a quantitative portfolio manager at ITG, and I was talking to him yesterday. He was talking about algos in the market, and then Alan DeLugash may have a question. We'll go to him and then take other questions. Mitch, you there?
Yeah, I'm here.
What are your thoughts?
Well, I'm going
Buy
to
with both hands. It's a bull market.
I'm going to focus very intraday, yesterday. I'll give you like genesis of the yesterday's market move that's moving on today. Something interesting happened. I was short the S&P yesterday, and I still lost money. So you got to ask me, how can I be such a loser? Very simple. I'm like shorting condors, expecting little moves to the downside with little, with little risk capital. Fine, it blew through my bottom, and then I had to go back, lick my wounds, and figure out what happened. This shouldn't have happened like this. And then my theory, I would like to know what you think, but I'm starting to think that there was a very significant sentiment shift yesterday that's going to impact everything that's been said today on this show as well. I'm really thinking this could be a perfect storm that started brewing yesterday, because yes, a lot of these algos are pulling back. Momentum players, they're not seeing new levels broken, so there's not a lot of bullish money going to the market. But more importantly, I think the data that we got yesterday is pretty much giving a final verdict between the battle of the bond traders and the Federal Reserve. The retail data was horrific. And this is actually extension of Amazon firing people before Christmas, which is unheard of. So I think the sentiment is shifting now. And that's a perfect storm with the technical quant traders and momentum traders that are pulling back as well. That yes, inflation is coming down, but not for the reason that the Fed said. but the reason that the bond market said interest rates are going down, inflation is going down, not because you're going to have more supply in the market, but because there absolutely won't be any demand. And that's also true. That's obviously true after the numbers we came yesterday. And one observation, the only other chip that the Federal Reserve has is the labor market being strong, which is absolute BS. And I can say that from the point where I stand. The only reason we have low unemployment, and the only reason Microsoft, who's our partner, and I work with them on a daily basis, fired 10,000 employees and not 100,000. I was told by Microsoft, technically, if this happened 20 years ago, we would have fired 100,000 people. We're not doing it now because we have cash to sustain, and we are afraid we won't find talent tomorrow. And that's the only reason the labor market is looking good. And I think Fed got that one wrong as well. So this could have been the perfect storm brewing yesterday. I think technical levels are proving it. Money flows are very negative. Just a quick comment on gold, Tyson. Yes, if you look at technicals and money flows, it kind of looks strange. I don't have a chart in front of me, but you all know how a chart of gold looks like. It's kind of in the middle of nowhere. It's very bullish, but it could be in this range for a while. But there's three factors that are also going very much into the gold's favor aside of the dollar, which is questionable if it's going to go further or not. And one of the big factors is that basically, yes, inflation is still not tamed. Second reason is I think the geopolitical situation that we have is really dramatical. And I think the war in Ukraine has yet to see its finale, and it's probably going to be in spring this year. There's a lot of unsettled things going in gold's favor. And I think eventually in this situation, even though it looks like it's middle of nowhere, we might see some volatility. But this is where you buy gold on dips and with very low risk. So I'm still very bullish on gold. I'm starting not to have an opinion about the Forex market, aside of being very closely monitoring Bank of Japan and the yen, because I think eventually this bull market in bonds will continue and Japanese yen might join it if this type of situation persists. The only forecast on longer than 24 hours, which I've been saying now that I can have for the markets, is buying volatility. You see the VIX at 20, you'll never see it again. Maybe you will, but that's a colossal buying opportunity. One thing I can say for sure, I'm not sure this is a bear market. No one really knows. But volatility this year is going to be probably the highest we've seen in the last 20 years. So VIX is late to the party, but they're here. And I think yesterday's that breaking point, among other things, volatility is going to be at a very high level. So not much, that's all from me, kind of like all over the place. But as I said, I'm still licking my wounds, so I'm not mentally fit to talk longer than I did just now.
No, that's fine. Alan, do you have any questions?
I do, and I have to tell you, I really enjoy getting in the weeds on these calls. But I myself am much more a bigger picture guy and a more fundamental guy. And I just want to throw out a couple of things. The last speaker was just saying he was all over the place. He's not going to hold a candle to my all over the place. Here's my thoughts, and I'd love to get comments on it. Profits. Where profits are now, I can't see profits being more than 200 on a going forward basis, because even though the only thing that's stopping us, I think, from going into a real recession is the fact that we've got so many more jobs available than unemployed people to fill them. And as we're losing all the employment from the Microsofts and the tech and whatever, the NFIB people are picking up all those people is my guess. And that's why the unemployment numbers are going to stay strong. But I can't see them being able to continue to be profitable. So we've got that. We've got the unemployment. We've got a debt fight going on. The country is in the midst. This is a potentially really horrific experience here when we got interest rates shooting the roof and we've had debt that's exploded the last couple of years. And it's it's almost not even possible to use the, to cut the budget on the, on that part of the budget that that we have control of on the disposable part of the budget. And so we're going to have the fights over the debt ceiling. We're going to have fights over whether we're going to fight entitlements at all. I mean, this is the time to do it right before an election. It's not going to work. Maybe we can do it now. And then my last comment I'm going to make is that how can we keep profits from tanking when, thinking back, the most important benefit Trump added to the economy, it was so strong during his years, were just two things: the cut in the corporate rates, and as a tax guy, I can tell you the cuts in the individual rates were less than meaningless. They were just really stupid, and we're going to have to go back and revisit them, and they were not meaningful in any way. But the cut in the corporate rate down to 21%, and most importantly, the direction and the work on regulation. So if regulation was so important to keep the economy strong during Trump, what's going on now with the morons that Biden has put in to head all the agencies, with the huge stuff going, the FTC, the SEC, talking about many more major regulations costing hundreds of millions of dollars than ever before. And I mean, I don't see how that's going to prevent the economy from becoming much weaker than I think people think it is. Anyway, that's what I got. And I'm just curious to any reactions.
You have a website. I didn't know that you have a blog. Can you tell us what that is? Because you actually write some things.
Yeah, I've been off it a little bit recently because of some personal factors, but it's taxpolitics.com. Spelt the way it sounds, except it ends IX instead of ICS. So that's TAXPOLITIX.
Well, I agree. I don't know how the hell S&P earnings don't go back to $200 per share. And it really surprises me that they're as positive as they are. And looking back at history, usually it is in the beginning of the year where you see the most dramatic revisions, because that's the time of year when people report their earnings, but they also make predictions on the full year. And so I mentioned before, and I showed that I actually get the S&P numbers on a weekly basis. And what happens over the next couple weeks is going to be very telling. I also think that nobody is talking about it, but you're absolutely right. There is, what, 31 trillion in debt. So if interest rates are going up, how that is not really starting to squeeze the budget. I saw somebody talk about it, but it really is, you know, there isn't much discussion. I mean, it's, you know, and unfortunately it is terribly political, you know, oh, well, you know, these Republicans are going to do this, you know. I don't like to look at it on a political lens. I just happen to study economics, and I believe that viable entities, you know, should be able to service their debt, and printing money the way the US has really been reckless. And frankly, they haven't been alone. I think that's why, you know, so many currencies I think are very questionable, which bolsters one of the reasons I'm positively inclined towards gold. Anyone else have any thoughts on Alan's comments or anyone else's?
I have a comment, if I can.
Please.
Oh, okay. So, and this relates back to what Mitch was saying, you know, market stuff. I agree about the volatility of in 2023, and because of the war in Ukraine and the unpredictability of Putin, and the changing geopolitics with China, Russia, OPEC, that equation. China is OPEC's #1 customer. China is now importing more from Russia. These matter, and this is what started changing the map of natural gas and turning things into more of a global and increasingly globalized natural gas market, i.e. LNG. And so it's changing the dynamics, and there's yes, the Europeans are responding well, and you see that reflected in their market, but you also have all this uncertainty still. And I was actually at a meeting last night that was actually on all this Russia, China, geopolitics, and outlooks, and how this ends, and all that sort of thing. And so I agree with the volatility idea, Mitch. And frankly, I don't think all the policy stuff is screaming at me like geopolitics is. And something that happened in the news, Mitch, I don't know if this is part of what you saw happen, but I noticed there was a lot of basically questionable China news. There were all those articles about China's aging population. China, they're getting older. They're not going to be, working in all the factories and doing all that. Like you can't count on China as the manufacturing hub of the world kind of ideas. And some of the challenges with their economy and their debt and this and that. And so if you're counting on China to to cancel out any recessionary impacts, and then there's all this news, it's like, well, we don't really know what's going to happen with China. That's a little bit more of a, bearish on some of that. But the thing is, jury's out. You don't really know, China is a centrally run economy, and yes, and they have the issues they have economically, but they can make decisions. They can make big decisions, and one of them is that they want to play hard in the hydrogen space. So there's just a lot of rhetoric and volatility, and it takes time to sort out the wheat from the shaft, right? So
yeah, can I just continue? Jennifer, obviously we agree, but I totally think, I know China, Russia very well, and I've been always since little, being from that part of the world, fanatical about geopolitics. I think geopolitics are going to be a big issue, a big unknown this year. And let me just quote Churchill, who brilliantly said, in time of war, truth is the first victim. So I can guarantee you, I have my sources of information, but the Western media is very much on par with the Chinese and Russian media. They're like a photo finish, who's lying more. And that is the problem. It's going to come and it's going to hit us hard. It has effects on everything we talked about, especially commodities. And it's really warming up, heating up, if you will, to be a real serious situation. So that's going to be a big wild card this year. People are forgetting. That's kind of psychology. When the war broke out, everyone was talking about it. It was like in the news, whatnot. Now it's like, it's okay, just another war. Well, I don't think so.
no.
And the China factor is also dramatic. You're absolutely right. If anyone can spin the truth and try to show you something the way you want to see it, not the way it is, that's the Chinese. And I know, it just happened to be working in Moscow and China, so I pretty much know the players. And I'm terrified that from the Monroe's Doctrine to Nixon and Kissinger, who are working their butts off to keep Russia and China away from each other, Biden manages to put them back together in a couple of weeks. I'm not a Republican whatsoever, and this is not endorsement of the next election campaign, but it's from the geopolitical sense, it was one of the most biggest and stupidest mistakes US could have made. And now we're going to have to live with that.
What was the biggest mistake?
That we actually let China and Russia back into a love affair. Okay, and that's not going to bode well for the US or EU or UK in any shape or form.
I don't know that you could really control that either, though. You know what I mean?
You can try.
The decisions that have been made, the overarching theme is that, we're a superpower, so we're a target, right? And, the desire for a multipolar world versus hegemons, right, is potentially compelling, for some actors and countries. And, you know, so you get into all of that. Now, what's really boggling my mind, and I haven't even wanted to think through this, and I will at some point, is what this looks like when it ends, you know, this war, and what it does to the energy map and how it changes things. We're still in it. We're in the dark in some respects, you know. Now, there's leadership, our economy, we have a good economy, strong economy. Europe's trying to, you know, patch this crisis up, right? You know, caused by the Russian invasion. And they're doing, you know, as best a job as they can. You know, but there's always economic self-interest at the end of the day that's a big driver. And Russia and China are constrained in the fact that they play in a global market for many of the things they do. So, you know, scorched earth, probably not. I can't imagine that would be a smart strategy, especially if Putin wants to stay in power. You know, but it's, you know, it's hard to predict. It's really hard to predict because of human nature, you know.
But I'll tell you, like, no one knows how this is going to end and where. That's why that's the volatility factor. But the last three places, when it ends, three places I wouldn't like to be or live in would be Ukraine, Russia, or the European Union. Everywhere else, maybe.
I don't want to live in China. Maybe Hong Kong.
It's fourth on my list, but they'll do
Preferably
fine.
Singapore. But sorry, Mitch, what were you saying?
Well, China was the fourth one on the list, but they'll be fine. You should live in Davos. You should live in Davos, Tyson, and just join the crowd there.
Well, I'm hearing a lot of things about Davos these days that are surprising. Anyone else have any thoughts? Jeff Karp, Randy Hughes.
Let's see here. Do you have time? Just have only two things I'd add. I heard Jennifer was talking about the percentage of stocks that are trading by programs and stuff like that are systematically traded. And I actually am doing business with systematic hedge funds on a daily basis right now. That's kind of what I do. Run some portfolios for them. But I had the guys at Hedgeye are putting out some interesting research. And I didn't know them a couple of years ago. I've gotten to know them over the last year. I think it's pretty interesting. The guy, Keith McCullough, runs the whole group over there. They're up to about 70 or 80 employees now. And I heard them on a talk about the markets, recently, saying that based on some JP Morgan data, that they believe that, program trading and algorithmic trading is probably accounting for close to 90% of all equity volumes these days. And just based on the way these stocks are acting, I think they're right. They're right. I would have guessed it would have been, 60 or 70%, but I'm not. I think they're probably spot on.
I've heard those higher numbers. I believe 90%, and they're, whether it's high frequency, but also tactical asset allocators, financial planners, but they're all keying off of quantitative metrics, some instantaneously, but some on a slower basis. But in aggregate, I think that they dominate.
They dominate, and and that's why, if you look back, I think I remember 3 years ago or thereabouts, Jeffrey Vinnick, his name popped up again, and he was alive and going to run some money. And after about 6 months, he said, "I'm done. This is not for me." And I believe that what's happened is the game's really changed. And that's why it's just not people. I'm not directing it at him, but a lot of these in the days of past, people would, talk up their books a little bit, and that would get people to buy and goose up the stocks. And you're not really, it's different. So I just wanted to chime in and say two things on that. What else did I say? I was going to say, heard Blackstone mentioned and I guess the Vanguard bond ETF, and I don't know all the details, but you know, and exactly what you were saying, but I know that Blackstone has a situation where they have a huge amount of REIT exposure, right? Or they have I'm not exactly sure what their situation is, but it's I think that it's a problematic situation. And I think that one of the California state pension funds placed, several $1 billion with them recently to kind of add some liquidity to the situation, but I don't know if that's fixed anything. Anybody have any thoughts on that?
Yeah, I forget what the name of it. Did they call it B-REIT?
Yes.
Something like
Yes,
70,
B-REIT.
$80 billion, and normally they pay out a dividend. Suddenly they were getting withdrawals, and suddenly they couldn't meet their the distributions. And to me, that sounded like a bell ringing in terms of a liquidation event, and something that really represents why I think real estate could be in trouble, and more trouble than what we're used to seeing. Now I don't know how that one's broken up, but I think that's telling, and yeah, maybe they got some nice big pension to bail them out. But
They have I've never listened to spent much attention on REITs, but Hedgeye actually has an outstanding analyst covering the space, and I've been very active in the space in a couple names because this guy's he's looking at the cash flows and the financial statements, listening to the conference calls, and calling management out on a lot of things. And one of the things that's happening right now is the corporate office space and REITs that are involved in corporate office space. They're right now in a serious bind because companies are not leasing space now, and you've got all this real estate, and it's a problem that's gonna have to be dealt with. So that's a big thing. And when you mentioned Blackstone, the light went off in my head because I wanted to just chime in on that and make sure everybody knew a little bit about that. I'm not. And this guy commented about that again this morning on their call. I listen to their call most days. I thought everybody had very good things to say today, and I thought, what, Tyson, I'm curious. You mentioned gold, and it sounds like there's some agreement. But do you think that are there gold stocks you'd be buying, or you think really the play is just to buy gold itself?
oh no, I'd buy the stocks. You get a lot more play out of it, and whether it's Barrick Gold or Sabine Stillwater. But I like the ETFs; those are good. GDX, GDXJ. There are a lot of little names, but I won't go into those. But yeah, you can make a lot of money. I have to congratulate Mitch Balaji. He told me to buy a company called Gold Mining, GLDG. I bought it at 93 cents, and it went to $1.60 between November and December, and I started selling some of it. And I was like, oh my God, look at that move. It pulled all the way back to 110. I bought it again, and I think it ticked 140. I mean, you're seeing in some of these little names enormous volatility, and it's those are resource plays. And so yeah, I think that there's a lot going on there. But going back to your point on real estate, somebody had told me about Carl Icahn and his investment REIT, and they own some credit default swaps. And on CNBC, Carl Icahn made the comment. He said, "You've got all these commercial real estate buildings that are worth $100 million with $80 million mortgages, and people don't want to go back to work. And at what point are banks going to have to start writing those things off?" And you're seeing, people are talking about it. Oh, well, everyone just wants to work at home, and that's a new work mantra, and everyone's just got to get used to it. But there are going to be some real consequences. And I believe that it was in Icahn Enterprises that he owned some credit default swaps. But you could see that people are going to say, well, no, I don't want to go back to those offices. And some are saying you have to. And, you know, I don't see 100% of employers being able to successfully get all their employees back. So I think that there's a real risk to Manhattan commercial real estate. And so, you know, I think that that's something worth watching out. I certainly hope that, you know, things don't get terrible here and we do have a soft landing. But
And the other thing along that line, you were talking about the commercial real estate. So Vornado, I think, is in that space. VNO is the ticker. They cut their dividend this morning or last night. And, you know, the analyst said, you know, the office market is structurally impaired. I mean, I'd keep shorting the names that I'm negative on.
so want to give us some other shorts?
I would love to. I can't. I'm in a couple of names that are not.
Okay, don't bother. I want to
PARA
wrap
was
this up though. Does any last questions? And I want to thank everyone for their time, but any burning desires, any last questions? I want to thank Mitch Belagic, Jennifer, Rich Gula of particular, Alan, Jeff Karp, you there? You're muted. Anyway, Randy, thank you. Thank
you.
everyone.
Thank you.
Well, all right. We'll see you next month.
That's good.